Raphael, Chris, Joe, Hank. Yeah. Okay. Market's hot. Weather's hot. Morning. Matt, Mike, Tony. Morning, Dave. Good morning, Buck. David,
We have a
Faith.
real tight range. You guys know I've been monitoring the opening range for the opening playbook. Last few days here live with you guys. A real tight range, one of the tightest ranges we've seen in months. That when I say range, I'm talking about the high and low price from 930 to 945. It was only 0.1% today. Typically, we're seeing zero point 0.3 to 0.7%. So very, very tight, choppy range at the open. We saw a pretty choppy one yesterday. If you guys followed along with that, I'm not sure if anyone here did that one yesterday. Let me just share my screen real quick. See what pops up here. That's my earnings calendar. Let me pull this up. Nate, as you know, we've been optimizing this strategy, trying to find the very best options to pick. 44 days in a row, we've hit the target, the 50% target. So here's such a tight range today that we got the signal to buy puts at 950, and now it's back to buy calls just because it's so tight. But we've seen plenty of times in the past where it's done both signals. I always go with the first one that's worked out the best in the past, but you can just see how tight this range is compared to something like, this doesn't really scale because let me hide these. Oops. Here you go. Let's see. 607, 606, 6078. So that's a buck 80 range. Let's see what 180. So there's a point 0.3 range. So triple the size of today's range. Yesterday was about 0.13. Today's really, really tight. We'll see what happens. But it's been a fun one, Nate. I was trying to say 44 days in a row without a loser. The loser was on May 12th. But it's on an absolute hot streak, and I've been taking advantage of it. Hopefully, you guys have been too.
Yeah, 44 days in a row on something active like that. It's pretty awesome. Um, you seeing the real estate sector just get pummeled right now?
No, but I'm not shocked.
Everything's pretty steady, and then real estate just getting hammered right now.
Back on. Um, I'm curious what your take is. It looks like Powell's term expires in what, 11 months?
Mm-hmm.
I'm really interested to see what's going to happen. My personal take is that the longest we can keep rates as high as possible without crashing the economy, the best. Uh,
Yeah, agreed.
have those tools in our toolbox for bad times. We don't want to throw all our tools out the window right now, in my opinion. But obviously, big push for rate cuts right now.
Yeah. Um, by the way, we've got ANET, a stock that we've obviously talked about in here quite a bit as a ticker that I'd jot down
Oh,
for
yeah.
today. Not only is ANET meeting a couple of the key criteria that I like to look at, some trend criteria, and all of that. It's got some nice institutional flow right now, and it's breaking that big solid 100 number, which is a pretty key support and resistance level.
Bill
The
Century Mark.
Yeah, yep. The daily chart, as you can see there, looking really healthy. So if we get a close that looks anything like the current candle looks right now, then I absolutely love ANET in its current position. And I think, yeah, I think we're headed to all time highs at some point with ANET. It's just a great stock, but this would be at least probably a good look for a move to 110 maybe on ANET. By the way, and Graham, you talked about this. Um, I like a lot of these stocks. Uh, got some breathing room to go higher. You talked about the SPY and some of in general. Some of these stocks like ANET got a little breathing room now, so I think this break could run up another 4, 5, 6% pretty easily because we're not feeling overextended like we are on some of the other stocks. I shared some of them yesterday that are overextended. I still like them, but I like the more defensive trades versus ANET. I think has some horsepower here to move higher.
And there's still a couple. I mean, like even Amazon has been kind of stuck. We'll see if it can get a break higher. Lilly's one that's been quietly trying to heat back up. We've seen this attempted before. We'll see what happens. You guys know healthcare is typically a decent sector in the summer months. But yeah, you're right. ANET is looking good. We had a trade up here in the opening playbook on it. Let's see, we're probably past the max. We're not past the max profit yet, but pretty darn close. 25 cents away, up 112%. So that's not too bad. ANET's, ANET's the stock that punched me in the face, but slowly making some money back on it
Yeah.
since that big correction.
Um, let me uh, let me also talk about. I do this review. I go through this quite a bit on how debit spreads actually work. But let me just real quick yesterday's overnight option trade. So here, this is the SPY here. Where are my overnight option members in the chat? Give me a yes in the chat. I know a lot of you are in here as always. So I actually got an email yesterday from someone that said they never hit their target on overnight options. And I wanted to walk you through because this is a case where I think most of us hit the target like around 10:40 a.m. or 11 a.m. But yesterday, if you look over here at the data window, yesterday's candle close here was 607.12. So it actually closed above our line in the sand, which means even if you didn't hit your target, at some point you would have hit it right at the close because it would have been a full 100%, not 100%, but full value of the spread win. So just to be clear here, I want to show you what happens in this situation. So our trade was 606 and 607. That was our spread. We closed at 607.12, as you can see there. So we closed above this line. What actually happens in that situation there is that we buy the shares because we have a call on 606, a bought call. We buy the shares at 606 times 100 because every option controls 100. So that's what we bought. And then the broker immediately, if it exercises at 607.12 here, immediately turns around and sells those shares at 607 times 100. Okay, so that's where we get the full value because if you buy shares at 606 and you sell shares at 607, you're going to make $1 per share times 100. So in this particular case, I think our entry was around 68 here. If you somehow didn't hit your target, which I don't think will technically be possible because I don't think the market will let that happen. But let's imagine that you didn't and it just exercised. Well, now you're getting $1 of value. So you would have made the full 32 cents, which in this case, would be like what is that? Like a 45% return or something like that. 68 paid, 32 return. So that's what would have happened here, just for clarity, because I did get some people saying, oh, it didn't hit the target. Well, in this case, we literally finished above and would have been in line for a full profit. So I walked through that debit spread case. I know quite a bit because I just think it's one of those things that is important to understand. Not everyone sees it, but here, by the way, we're right there. Wait, hold on. Randy, we just hit all-time highs?
No, I just looked on the SPY. I didn't see it on the SPY. QQQ's at all-time highs.
I know, but SPY 609.29.
No, we like 613 as the highest. Let's see. High price on SPY. Oh, 611.49. Oh no, 613.23 is our high number.
Why do I have 609? Oh, wait, I have 609.59 February. Is that not
Uh,
our high?
no, no, no. February 19th, 613.23. Let me look at the future, see what we got there. Give you the exact.
Uh, why does my high say
You know
609?
what? I don't know why, because we're at all-time highs on the futures right now on the SPY.
Are you
Yes.
sure you're not looking at with dividends included or something or something else? My high on the actual SPY shows 609.59.
My high on the SPY shows 613.23. That's in Thinkorswim, Schwab.
Unless maybe because the overnight high was higher.
Oh, it could be. But the futures, regardless, futures markets, and
Yeah, I say screw Graham's charts. I think we hit all-time highs, folks.
I think we did too.
Which means that last week, now you all have to shame on Graham because last week Graham said, "Oh, I'm not sure about June. It might not happen." And I said, "Guys, I'm still sticking with June. It's going to happen." So everyone, shame on Graham.
Shame on me for being the only person in April to say June we'd hit new highs.
No, it's true. I think me and Graham both get a little. If we can pat ourselves on the back, I think we both get a little credit for being
Well,
as aggressively bullish as we were during the very negative. And actually, it was Graham. Let me switch and actually give Graham full credit because I was bullish pretty early, and I was saying June last week. But the main reason that I was as bullish is because Graham did the initial research showing that those quick flushes, the quicker the flush, the better the recovery. He was really the one who did the initial research. Then I stole his research and got really bullish after that. So now I have to flip back and give Graham the full credit there.
and then last week or whenever it was CPI, and then I retracted my big bold claim and said, let's stick with July instead. But here we are, June, end of June, we made it. June 26th, couple days to spare, we made it, all-time highs.
I wonder if that 613 is the overnight high from maybe February 18th, 19th, or 20th. Well, it would have had to be the 19th, really.
Yeah, I'm not sure, but what matters is we got fresh highs across the board.
I love
That-
it. I love it. I love it.
which can't be good for my XSP trade. It's just floating around.
Did you do a short today or did
I
you?
did. Yeah.
Okay.
It was a tight range, but we had the breakout to the downside this morning. But I even told Florian, who's my assistant, I said, hey, tight range. We might just see some chop today. We'll see what happens, but let's keep the testing going. You got to take it every day with the signal, you know.
Yeah. Well, I wouldn't be surprised though if we get, because now we are, at least according to me, we are at highs here. I actually wouldn't be surprised if we now get a little jump back and a test back lower, which might get you a win.
We'll see. We'll see how it shakes out. But I'm not going to stare at the charts here. Let's go ahead and jump over to here to the
Well,
opening.
before you go into this, let me just say this might blow you guys' minds. I mean, this might be one of the more shocking things because, listen, I have been trading for a decade plus. I had not totally realized this until Graham and I were going through, and he sent me a message saying, "Hey, do you realize how off base we are on some of these assumptions?" I won't blow the lid off of it, and I'll let Graham do that, but pretty crazy. So I think number one, it's going to be pretty shocking, and number two, I'm hoping that this is also a demonstration of why Opening Playbook is so freaking valuable, why you should come every day. Because not only are you going to learn, I think, something pretty wild today, but you're also going to get some tools, some free tools and things that are, I don't think you'll get anywhere else. I don't think there's anywhere else where you're going to get guys, researching their butts off to show stuff and then build free tools to help you get understanding. So hopefully by the end of this, you'll be absolutely more pumped than ever to be an Opening Playbook attendee.
And just full disclosure, what I'm going to show you today actually goes against what I've been taught for years.
Oh, same.
When I saw it, I actually sent it to Nate the other day. And he says, you must have done the math wrong. Like
I
something
did
has
say
to be
that.
wrong. It can't be true. But we ran it 1,000 different times just to make 2,000% sure that we were right. And it's shocking. And I think some of you guys will be a little shocked today. And it's funny at the end of the class, you might be slightly confused. Hopefully that's not my intention, but this is like such mind-boggling information that it leaves you just kind of, I mean, mind-boggled. And you're like, what
Uh,
is the answer? So
yeah. No, well, I number one, confirmed that the math was correct after I told you you definitely did the math wrong. And number two, I built a little tool to help confirm and demo that out, which we'll mess around with today as well.
perfect. So buckle up, guys, because today I've got a very, very important question for you. And I've been asking in Telegram, I've been teasing in Telegram, which trader makes more money? Now, I want you to open up your chat and select the everyone feature. So when I ask you this question, you can post the chat and we can see everyone's results. So this is trader one versus trader two, and we're going to go down their stat sheet. And these are hypothetical traders. But Trader 1 has a 99% win rate. Trader 2 has a 60% win rate. Which trader makes more money?
A lot of you guys are still posting to host and panelists. You want to change that little blue bubble right above where you're typing to the word everyone.
And a lot of you guys are right. There's not enough information. All we can see is win rate. That doesn't tell us what we need to know. All we know is Trader 1's nailing it 99% of the time. Trader 2, you normally look at a 60% win rate and you say, that's fine. That's not the best. But you guys ready for this one? How about now? Which trader makes more money?
Profit factor. Okay. Obviously, I'm going to type in, obviously, it's number one. You made it too easy, Graham. Clearly, it is number one with a 4.95
99% win
profit
rate,
factor.
495 profit factor versus Trader 2, 60% win rate, 1.5 profit factor. We all have been taught the bigger the profit factor, the more money you make, right? The more profitable the trader is, right?
Obviously.
Well, if we break it down further and see how they got to that profit factor, average winner for Trader 1, 5%. Trader 2, though, average winner is 100%. Much different return there. If you look at their average returns, 3.95. So he wins 99 trades at 5%, loses one. He's at 3.95 average return versus Trader 2 wins six at 100% and loses four at minus 100%. He has an average return of 20% per trade. So which one makes more money at the end of the day? The one with the 60% win rate and 1.5 profit factor makes five times the amount of money as the person with the 99% win rate and 4.95 profit factor.
And guys, this is insane because I told Graham, the only way that a 1.5 profit factor can make more money is on more trades. The only possible explanation is if 1.5 profit factor has more trades. Well, turns out that is dead wrong, and we've been taught BS for a decade about how profit factors work. And I'm a math guy. I love the math, and I still never second guessed this idea.
Yeah. And it's crazy to me because I mean you think of the word profit factor and what it means is how much you make for every dollar lost. That looks way better. I'd much rather make almost $5 for every dollar lost than a buck 50 for every dollar lost. But at the end of the day, this guy is making way, 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 way more money. So we had a couple people in the chat ask, how can that be? And
I had
I
the
saw
same
this,
question.
Nate saw this, and we both said, how can that be? Well, the truth is, at the end of the day, I think you guys know this. Win rate really means nothing. You guys were spot on in the chat. Like it doesn't tell you anything. Profit factor, in fact, doesn't really mean anything either, because as we saw, three times the profit factor meant absolutely nothing at the end of the day. What matters is your return size, really your average return per trade. So if I were to show you this chart over again and only show you this stat here, I think everybody would say Trader 2 makes more money.
And just to be clear, so risk to reward doesn't matter either, guys. It's the average return. Because I get a lot of people go the other way. They don't say win rate matters. They say, oh, never trade with a negative risk to reward. They say something offhand like that. That doesn't matter either. It's the actual average return that matters.
Right. Right. So let's quickly debunk this profit factor myth by breaking it down. Let me show you how it's calculated. So then you can see exactly why it doesn't matter. So after 100 trades, we're just assuming a $1,000 starting stake for each trader. No differences, same amount of trades, same starting stake. After the first 100 trades, Trader 1 only makes 4,950 in gains because he's going for those 5% winners. He gets 99 of them, gets him close to 5 grand. Trader 2, though, who's getting a 60% win rate at 100% returns, is up 60 grand. Now, when we add in their losses, Trader 1 takes one loss out of 100, loses $1,000. Trader 2 loses 40% of the time. He's down 40 grand in losses. The profit factor there is the gains divided by the losses, 495, 1.5. But the dollar return, the actual money made at the end of the day, way better with the lower profit factor. Crazy. MCP, how can I join Trader 2? That's funny. Well, hopefully we can help you get there in the opening playbook. So Trader 2 is actually five times more profitable than Trader 1. Again, same starting stake, same amount of trades, same time frame. different average returns is what makes the difference. So just as a special note here, let's not throw profit factor out the window completely. You do want to see a profit factor above one. If it's below one, it just means it's not a profitable strategy. So you always want to see one above one, but it doesn't necessarily mean that the higher the better. Because to me, and I think for you guys too, isn't it shocking that a strategy with a profit factor of 1.5 can be 5 times more profitable than one with 495? I think we can all agree there. And this has nothing to do with like allocation, percent size allocated in each trade. That we're all assuming the same, $1,000 in each trade. So do we agree now? And this is a hard one because again, for me, for the last 5 years, I thought the better the profit factor, the better the strategy. Do we agree that profit factor is not an important metric really anymore? It's not what the number one it used to be.
I can't believe I'm saying it, but yes, I agree.
First thing I'd ever look at in a strategy, wow, the profit factor. That's amazing. That's clearly better based on profit factor, but it's really not an important number. So another example, again, just to restate it here, trader A, let's say he makes a $40 gain and $10 loss on the same investment stake. That's a $4 or 4 profit factor versus trader B makes a 4,000 gain and a $2,000 loss. He only has a profit factor of 2. But trader B is 10 times more profitable in actual money made. Wild. Now, there's nothing wrong with knowing the profit factor, but it's not an apples to apples metric. We can't just look at this person's profit factor and this person's to say who's better. So, how can we compare which of our strategies are better than others? And this is like the $1 million question. And Nate, I'm curious to see what your answer is on it. I give an answer here, but it still doesn't completely put the piece in the puzzle, and I'll show you why. Now, I'll obviously ask my good friend ChatGPT what it thinks, what's the perfect metric. And it didn't give me one. It just said win rate's a head fake. Ignore win rate. High win rate strategies doesn't mean it's a good strategy. What matters is the average return of the trade. And that's what I've kind of been saying as well. So the best way, in my opinion, to calculate the most profitable strategies is looking at the compounded annual growth rate, right? Like the average annual return, like that S&P is 10%. We want to know what our strategies look like as a whole. And this kind of answers the question for us, which strategy can actually grow my $1,000 or $5,000 or $10,000 the fastest in real life? So it gives us the total profit over time. We all know the capital at risk, hold duration, trade frequency. All of those are important factors baked into it. So the question is, how can we calculate it? Well, I made a fun, fancy dancy calculator for you guys here last night. I'll walk you through. I'll drop it here in the chat. Make sure it's shared. And Nate's got a better one. But here's just a basic one. So if you want to know, this is the metric you want to know, in my opinion, and you would just punch in. So this one I did the perfect Bitcoin trade, which is one of my premium portfolios. It started on 2/7/2024. And this is the number I put in blue here, the ones that you'd want to change when you make a copy. So don't change the white cells. These are formulas, or the green one. So it started on 2/7/2024. This is just today's date. It's been active for 505 days. Starting balance was $5,000 and now it's at 14,545. So this is the number it gives us, 116% compounded annual growth rate. If I had a strategy, and I'm just going to mess with this, if it started back in May 2023, and let's say it's only up to 7,500, it should pull that number for you. So you can get this stat and sort of compare apples to apples. Now I'll just reset this. So there's a fun little calculator for you guys. Again, Nate's going to show you an even better one here in a moment, but let me just walk you through, and that's the wrong slide deck. Here we go. There's a few important things when you're trying to compare strategies here. You need to be apples to apples on position sizing. So let's say you have a $5,000 account. You don't want one risking 25% per trade and the other one risking 1% because that's going to skew your numbers. So for example, you'd want to have the same percentage of capital allocated and you don't want overlapping trades. I'll break that down in a minute. So first, let's start with the position sizing. So here's the perfect Bitcoin trade, right? Compounded annual growth rate at 241%, perfect income 111%. Perfect Bitcoin's clearly the better trade, right? It's outperforming the perfect income trade. Well, not so fast. because you need to have apples to apples in the percent allocated so you can compare them as closely as possible. Right now, the perfect Bitcoin trade in my calculator I built here was allocating 20% of the portfolio to each trade, whereas in this calculation screenshot, the perfect income trade was allocating only 5%. So, of course, it's going to grow slower. So, we want to see those metrics be the same to get an apples to apples comparison. And now, when you look at it, totally different numbers. 241%, which is obviously outstanding and insane. But now the perfect income trade, instead of 111%, when you have that same percentage allocation, 885%, which I did this yesterday, last night, and I sent Nate, I said, wow, the perfect income trade is absolutely demolishing because I didn't calculate this before. And just to see that number was wild. Now, of course, the higher the allocation, the bigger this number may be, and the lower the allocation, the smaller the number might be. And it is a kind of a bell curve, if you will, where you can fine tune it to a point where it looks the biggest number possible. But if I get to 100% allocation, which you shouldn't do, this is going to be a big fat zero because eventually you're going to take a loser and it's going to wipe out your portfolio. So the making sure it's apples to apples is important. So if you're going to use that calculator I sent you and you want to compare two strategies, make sure they're apples to apples. And then secondarily, and this is kind of the bigger problem I ran into, you can't run a strategy that can't afford to trade itself. So that allocation percentage really matters. So for example, the on the clock stocks, which is one of my programs, a seasonality program, can hold as many as 6 to 7 positions at a time. So if I put 20% allocation in here, that doesn't make any sense because I can only hold 5 positions at a time. To hold 7, I'd have to use 140% of the portfolio, which is impossible unless you're taking out margin. So instead, a portfolio like on the clock stocks could only take 10% allocation, for example. That allows us to take 10 trades at once. And you can see how the CAGR, the compounded annual growth rate, changes based on that number. So if I were to compare something to on the clock stocks, apples to apples, and say 10% allocation, again, you would just line them both up, 10% and 10%, to compare the CAGR to see which one outperforms. Now, obviously, again, both are incredible, but in this instance, perfect income trade does a little bit better, about twice as good.
Well, and there's I think something to include there too, Graham, which is if the trades recycle more quickly, giving you the chance to have a higher allocation, that's an advantage as well. So the fact that perfect income, you could do a higher allocation, not that maybe should go over 10%, that's probably about the highest you'd want to go. But just the fact that you could go higher because you're not having to hold 8 stocks at one time is an advantage just to understand about the strategy as well.
Oh, Nate.
Oh, oh,
Let's
sorry. Did I jump the gun?
Then we run into another question here.
Sorry. Okay. My
Is
bad.
it really fair to compare a strategy like perfect income trade, which holds mostly one at a time, sometimes two at a time, to on the clock stocks that's taking 5 to 7 at a time when perfect income, can in theory, use much more scale or more capital allocated than
Okay.
on the
Here we
clock since it's tying up less capital at a time? And this sort of things get really complex, more confusing. What is the answer? Well, I think now we can all agree it's not the win rate. That's not what we're going to use. And as I showed you, it's not the profit factor either. But I'm going to be honest here, after testing a bunch of different formulas, equations, and even trying to use ChatGPT to give me an answer, which, to be frank, I love ChatGPT. It was terrible. It was
Yeah.
bad math everywhere. But that's just a side note. But really, I haven't found one that can give us a true side-by-side scoring metric. Not yet. My hope is that we'll have one that's perfect for scoring apples to apples here soon. But in my opinion, this is just good rules of thumbs. The key metrics you want to know when comparing a strategy is the average percent return, right? We want to see that size, average, and that's not the winners. This is winners and losers. So if you're to take all of the trades and average them out, what is that number? You want to know the hold time and then also the frequency of trade. So general rule of thumb, average percent return per trade. Again, that is winners and losers. Don't let anyone just tell you about the average winner because that's a number that also doesn't matter until you know the average of winners and losers. Obviously, the bigger the number, the better the strategy. You want to see that number as big as possible. You also want to consider the average hold time because the smaller, if something holds us, a position for 200 days and it's got 100% average return, and something holds a trade for 1 week and it's got 100% average return, well, the smaller number is going to give you a chance to scale faster. So average percent return, you want the bigger, the better. Average hold time, it's not necessarily the big or the smaller the better. It's just the smaller the number, the faster you can scale. But even so, what really matters in hand with the hold time is the frequency of trades. So in my opinion, the optimal strategy matches up the average hold time with the average amount of trades. So if your average hold time is 1 day, you would like to see one trade per day. If it's a 1 week hold time, maybe see one per week, if that makes sense. Now, here's where things are probably going to get a little bit confusing, but if it's a 1 week hold time and one trade per week, that's perfect. If it's a 1 week hold time and 2 or 3 trades per week, that's no problem, but it's not going to help you scale faster. You're just going to allocate your portfolio into smaller chunks. However, if it's a 1 week hold time and you only get one trade per month, you're just going to see slower growth. So that 1-to-1 ratio is the perfect metric, in my opinion. Now, it doesn't mean every strategy has to be that, but you want to be as close to that as possible. Same for if you have 1 day hold time, one per day is perfect. If you have a 1 day hold time and you're taking 2 trades per day, that's fine. It's not going to help you scale any faster. It's no problem. Whereas if you have a 1 day hold time and you're only taking one per week, you're just going to see slower growth.
Yeah.
So that is my big old shocking discovery in a nutshell. That profit factor has been officially debunked for me. I'll still keep it in the trade trackers, but again, I for years assumed bigger the profit factor, the better the strategy. But that is simply not the case at all.
Yeah. Pretty crazy. Now let's dive a little deeper. Do you want to dive deeper now, Graham, or do you want to? Can I take over and
Go for it.
because if we haven't made your brains numb enough yet, yeah, yesterday on the or Monday on the what was that Tuesday on the income masterclass, I did an entire diatribe on pot odds and making people's brain hurts with math, and then we jumped into this, so we're really going heavy here. But this is what I built for you guys. So after we got going on this conversation, I got really thinking, this is crazy. People need to understand this. They needed a way to evaluate it. And so I built this puppy out for you guys where you can start actually running these numbers and seeing what the expected returns, how different factors are going to impact your expected drawdown, how sensitive your win rate and stuff is going to be. All of that kind of stuff is baked into here. So we can go through some different scenarios like Graham was just describing and kind of see what the actual impacts are based on something like this. So for example, this is set with 100 trades per year expected, average duration 7 days, win rate 60%, ROI 15, losers minus 8%, kind of your steady strategy here. And it gives you a really nice equity curve, as you can see here. Here you can see if you start with $10,000, you're going to end up with about a 77% annual return. Here you have the Sharpe factor or Sharpe ratio that I think someone, LK maybe was pointing out, and so forth. But what's cool about this is you can see if you change the numbers here with a black background, you can start to see how different things impact. For example, like Graham was saying, just more trades mean a lot. So go from 100 trades to 200 trades and look at that equity curve. It's not going to double. It's going to more than double because we have compounding set to true here. So your average is going to go up here. Your Sharpe ratio is going to go up. Everything's going to go up simply by adding more fuel to the fire, so to speak, through trades. Let's go back to 100 here. So let's go to 100, back to our equity curve, but then say that our win rate goes from 60 up to 70. Well, that's also going to have an outsized impact, right? Now, let's say that we actually want to go more aggressive. And instead of risking $1,000 per trade, we want to risk $2,000 per trade. Well, now you're going to start getting that hockey stick curve up because obviously the allocation is going to have a big impact. I would actually argue that with a profitable system, the percent allocation is going to be the biggest needle mover. It's going to have, in a compounding strategy, it's going to have a bigger impact on that ROI than anything else, but it's also going to impact that expected drawdown, right? Because the bigger you go, the more expected drawdown you can have. Here, your drawdown estimate is pretty low because you're only losing about 8% per trade and you have multiple trades open at the same time with 100 trades, but it will, increase as you go higher in size. By the way, I do need to do a couple more checks before I throw this in the Opening Playbook VIP members area. I just want to go through and triple check all my math here because there's a lot of math in here. And this was kind of my first iteration that I just wanted to show you out of the gate. So I might need to clean up a couple little formulas here, but generally, this is what's going to kind of tell you as you plan a system. So let's plan a system together. Let's say that we have a system that's going to trade every day. It's going to trade 210 days out of the year. The average hold time is just going to be 1 day on it. The win rate is going to be like 85%. So it's going to be a high win rate strategy. The average ROI on the winner is going to be like a 25%, ROI on the average. And then the average loser is going to be like negative 100. So you're going to lose the whole thing whenever you lose. Well, now you can see, even though that's a really negative risk reward, you're only winning 25% when you win, and you're losing the full trade when you lose, still a pretty phenomenal equity curve, right? So again, this kind of, I think, shows, and hopefully this whole class gives you an indication of one metric is not really going to tell you anything. It's going to be a combination of metrics. So in this case, you took a $10,000 account into 43,000. You had a 436% CAGR, the CAGR there, because you had good enough win rates and ROI relative to the risk reward, not one or the other. Now take this time period and go to 5 years, and you'll see a pretty monster equity curve there. Right now, now you're going to have $44 million over the course of 5 years if you can maintain that. Obviously, that's compounding and super aggressive, but that's essentially what we're trying to do in something like overnight options. Not make 44 million, but have a good enough profit factor that even at 1 year, if it doesn't look amazing, the compounded hammering that profit factor enough times gives you an advantage. So this is like an overnight option strategy idea where high enough win rate, even with a negative risk reward, and trading every day gives you an advantage. Now let's flip it and do something very, very different. Let's say instead of 210 trades, we have 50 trades. So we basically have one trade a week. But our win rate here is, let's say 65. But in this case, let's say our average winner here is like 180%. And then our average loser is something like 60 to 7, let's say 70. Okay, so now you're in a situation, and let's make this 7. Let's make that where your average into the trade is 500. Okay, and now you still get a really, really nice ROI because the winners are bigger. Okay, so the winners are bigger, and your win rate is dropped down. So totally different set of criteria. But if you put this out to 5 years, you're still going to get a massive, $530 million. There you go. Who wouldn't want that? So again, there are a lot of different ways systematically to achieve really profitable objectives. Oh yeah, yes. Someone pointed out this says month. It should actually say year. That's over 12 years. See, I gotta fine tune a couple of these things. But a lot of different ways to achieve the same kind of criteria. So one of the things I've gotten a ton of questions about is the income machine. Should I take more conservative trades and stack them up and have a whole bunch kind of floating at the same time? Should I take more aggressive trades with less? Well, you can kind of run the numbers on something like this to give yourself an idea. So let's say that you take a new conservative trade twice a week. So you're going to have 100 conservative trades. Your average hold time is going to be like 30 days, let's say. Your win rate hopefully is going to be in the low 90s, let's say 92%. But your average ROI here is going to only be, maybe 12%. And your average loser might be 100%. And then you're going to have $1,000 or so allocated here. So you can see that's going to be a really low drawdown. It's going to be a very conservative strategy. And over time, you're gonna actually need the time itself to make up for a big component here because you're only getting 11, 12% on an average trade, right? Now, if you wanted to be more aggressive, then you could maybe take 50 trades, go down to a low 80 win rate, 83, 84, but get this average win up into the 25 range. Okay. Now you're going to have similar ROI, similar, that Sharpe ratio, things like that, but you have a bigger ROI and you can probably put a little more capital per trade because you have less trades. And that's going to have, a fairly big impact overall on the equity curve simply because the allocation is going to create a larger win. And then some of the numbers that Graham was talking about here, like the average actual trade return, which I think is probably one of the most important numbers because then you know how many times you can multiply it over and stuff like that. So I'm going to put this in the members area for Opening Playbook VIP. I just got to go through, do a couple final checks on it because I think there's a couple numbers that are still I need to calculate and take into account all the details and stuff like that. By the way, this would be like 15, not 30. But I'm going to put this in the Opening Playbook VIP area where you can make a copy of this sheet, change around these numbers as you think about your system mechanics, and then say, okay, do I want to be more aggressive? Do I want to trade a strategy that has more trades? All that kind of stuff you can kind of play around with and see what the impact is. So hopefully this is helpful. Like I said, Graham and I started talking about this. It was kind of blowing our minds. And so we ended up going a little bit deeper into the weeds here than we initially talked about. And we wanted to kind of build some stuff out to show you how cool this would be. So I just put this together like in the last couple of hours. So I need to do a little cleanup, like I said. But as soon as I get that cleaned up, I'll get it in the Opening Playbook VIP area for everyone in here.
Now, here's a question for everyone. Whose brain hurts after today's session? Because I know mine does, but it's awesome. And thank you for putting that together. Looking forward to seeing that get fine-tuned and maybe we come up with a new metric.
Maybe we'll come up with the Opening Playbook score. That's the official.
There you go. And we'll go around grading everyone's trade trackers. We'll get Lance in here, put him on the spot.
Yeah,
Lance,
exactly.
what is your Opening Playbook score? Roger? That'd be fun.
Yeah. So one of the questions, I mean, you guys can tell us one of the questions I'm curious about. Well, okay, guys. Well, in a minute, I think we're going to do one more chance for the Opening Playbook here in a minute. So that's a lot simpler. No brain hurting required for Income Playbook because it does all our Income Machine because it does all the work for you. Literally prints out the idea, prints out the opportunity, the exact options, all that. So if your brain hurts, and you want to have to figure it out. Well, then I highly recommend the Opening Playbook. By the way, I got one question here. For all my Opening Playbook people, maybe I'll let you guys answer in the chat. Someone said, do they need to go back and watch the recordings of the master classes or just attend the future live ones? I think they're fairly redundant. Like we talk about a lot of the same stuff, but there's kind of mini lessons baked in to each one. So if you're in the Income Machine and you've gone through all of them, maybe you could answer that better than I can because my perspective is probably a little bit shifted, whether it's beneficial to go through every masterclass or just start attending the live ones and go from there. I don't know which one you think is more valuable. The other question that I'm curious before we kick off here is, do you guys like, for Opening Playbook, do you like the sessions where we are more lesson focused, trying to teach you like kind of fundamental truths about the market, about systems, about trading? Or do you like more of the market action trading sessions? Or do you like a mix of both? Because that's one of the things we're always trying to kind of dial in for our members on Opening Playbook here is to make sure we're not just giving you, a trade idea that's good for that day. But we also don't want to, hurt your brain every day with some deep mathematical dive. So curious what you guys think on that one as well. A couple people on Income Machine said, go back and watch the replays. We cover some different ground in each. Seems like everyone is saying that the mix, which is, I think, kind of what we have right now. So we will kind of keep it going. Bring the brain hurt, Mike said. Okay. Well, we'll probably try to keep that mix, and we've got a couple other things in our list here of kind of trading lessons and things that I think most people have either undervalued or not totally understand. And so we'll do that. The other thing we want to do is get you into the income machine before our next live trading session, which is going to be today. So that's been my mission the last couple of weeks.